What's going on, money lovers? Welcome back. So today we're going to be talking about QYLD, or the Global X Nasdaq 100 Covered Call ETF, an ETF that yields around 11% annually, so almost 1% per month. Now it fluctuates a little bit, and it's currently yielding 11.8%, so almost 12%, about 1% per month. It pays out monthly. It is a great ETF if you are looking to retire soon, or you just want some extra consistent cash flow to pay bills. Really, if you're just an income investor, or someone like myself who invests in a mixture of growth and income from things like dividend stocks and options. So with this fund, you could get a pretty steady and reliable flow of 1% yield each month. And we're going to talk about what exactly this fund is, how they're able to pay such a high yield, and whether it's worth your investment. So QYLD writes covered calls on the Nasdaq 100. So essentially, really quick, if you don't know about options, they're basically buying shares as if they were a Nasdaq 100 index. Then they sell covered calls on those shares to generate premium. Now, generally, if you know what you're doing with options, you could make on the low end at least 1 to 2% a month with relative consistency, and that's going for more conservative options. And on the higher end, if you really know what you're doing and you're open to a higher level of risk, you could probably make 3 to 4% pretty consistently is the consensus. It is known, Khaleesi. So that's another perk of this. It's a passive way to do options basically as well. Instead of you actively trying to find stocks to sell puts on, sell covered calls on, definitely is a little bit more hands-on and something that you need to keep tabs on more regularly. You could instead put your money in something like this, where you're just generating that 1% per month without having to do anything, a more passive approach. I've been investing in a mixture of QYLD. I also own XYLD, which is basically the same kind of covered call ETF, but it tracks the S&P 500 instead of the Nasdaq. And if you're interested in learning more about that one, let me know in the comments below, and I can make a video on the future. But anyway, QYLD. So it's been around since 2013, got $3.4 billion of assets under management. The expense ratio comes out to 0.6. So for every $100 that you make with this fund, you're paying an expense ratio equivalent to 60 cents. Really not bad when you consider you're going to be making $11 a year basically on that $100. So you're just taking away the 60 cents. We're still talking at least $9 or $10. $9 or $10 or 9 or 10% return after the expense ratio is taken out. Now, obviously, that's not factoring in taxes, which depending on your tax bracket, you'd have to figure out. Just keep in mind that will be an additional expense. So why should you invest in QYLD? They seek to generate income through the covered call writing, which I briefly explained earlier, which historically produces higher yields in periods of volatility. So this is another thing that got me interested in options was the market has been very volatile, and at the same time, everything's kind of at a high. So I started looking for different opportunities to, further diversify and just get more consistent, steady cash flow. And another thing that's great about these income ETFs is if you're a dividend investor or you're just getting started and you think you're interested in, focusing on dividends more, it can be discouraging at first when you're buying, one share of a company and it's only paying you a 1%, 2% dividend. You feel like you're wasting your time. You're not getting very far. Although over the long term, the compounding effect will be worth the wait. But if you want to just fast track it a little bit, it doesn't hurt to throw in something like a QYLD, which is what I did, which can help bring up your average yield on your portfolio if you do hold, let's say, companies like Apple that pay small dividends. They've made monthly distributions 7 years running since the fund's inception in 2013. So while it does fluctuate a little bit, it has remained pretty consistent thus far. QYLD writes call options on the Nasdaq 100 index, saving investors the time and potential expense of doing so individually. So I mentioned earlier, it's a passive way to do options. And also, when you do options independently, you are paying fees. So that's another thing to take into account. That's all baked into this 0.6% expense ratio that they charge here. So as you can see here, the top holdings mirrors that of the Nasdaq 100. So these top 10 holdings make up 56% of the weighting. So there's definitely pros and cons to this. You're going to have more taxable income because with stocks, you only get taxed when you sell. But since you're getting this yield every month, every time you get that yield payment, that's a taxable event, right? Unless you own this in something like a Roth IRA, which is tax-free. But as you can see, you're not going to get very much capital appreciation, so this is definitely not for a growth investor. And although this chart looks a little wonky, it's got some seemingly big highs and lows. If we go back to the pandemic crash in 2020, this only went from $24 to $18. So yeah, while it's a 25% loss, it still fared better than the broader market did. And it quickly came back, and this was a great opportunity if you had bought in here to lock in an even better yield on cost. Now let's compare QYLD to something like QQQ, which tracks the stocks of the Nasdaq 100. It's just a regular index that does not do any options activity, so no covered calls. It simply tracks the Nasdaq 100 holdings and owns stocks that are weighted accordingly. We can compare the returns. Figure, again, with QYLD, you're not getting much capital appreciation, but you're getting almost 12% a year. So with QQQ in 2020, monster year, it had 50%. 2019, it made 39%, so that's far outperforming QYLD. But in 2018, it lost 0.14%. So while tech stocks have been on fire clearly the last decade, and QQQ has far outperformed QYLD, it still doesn't mean you should rule out QYLD, especially if you're close to retirement or you want steady income, because as we can see here, QQQ is a lot more inconsistent, 50% some years, 3% other years, negative some years. Obviously with the crash in 08, it went down 42%. So if you're close to retirement, you don't want all your money in something like this, because let's say there is another big crash, you don't have that timeline to recover. But with a QYLD, it should stay consistent and you can still rely on that income. So there's definitely a place for both of these types of funds, I think, in everyone's portfolio. I personally like to mix growth and cash flow to get the best of both worlds, is the way I see it. While QYLD is not something I would put all my money into, I think it deserves at least a small position in the portfolio. And this is probably something that as I get older and it has still proved its consistency, I probably will start to increase that weighting, just so that I am switching over to consistent cash flow that's passive income. I don't have to worry about much, I don't care if the market's going up or down, I'm getting this money every month, which to me, I could sleep easy at night. That's the dream. So let me know what you think of QYLD in the comments below. Are you a fan of this covered call ETF? Why or why not? If you enjoyed the video today, please don't forget to like and subscribe for more. Let me know what you want to see more of in the future. This is Vinny from the Investment Club, and I'll see you next time.